Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I absolutely love the McAlvany weekly commentary. I don't think I've missed a single episode for years now. I think I missed one episode maybe in the last 10 years since I found the podcast. It is an absolutely incredible resource for great information and education. He hosts that. He's also the author of The Intentional Legacy, which is a very interesting self-help book, and all the things he overcame to become the man that he is now, running a very successful family business. And he's the CEO of the McAlvany Financial Companies, which are McAlvany Wealth Management. They have a bullion dealer, and they also, I think, have rare coins. They were the first family to help get gold legalized back in the United States. An incredible story. David's dad, Don McAlvany. So, David McAlvany, thank you for joining me again.
Hey, great to be back with you again.
So, David, I want to get your opinion on this, what I call Repo Madness. Other people are calling it Repo Madness now, too. It started late night on September 16th. We started getting stories out about it on September 17th. Here we are over a month later now. The repos, what started at $35 billion per month, and then they added the term repos. Now, first it was at least $75 billion. Now it's up to, at least $120 billion when we're recording this interview on Friday, November 1st, 2019. And the Fed's balance sheet has increased a lot since the end of August. It's up almost $260 billion, and the not QE program is only $60 billion a month. You covered the Repo Madness on one of your podcasts in the last couple weeks. You talked about the Bank of New York Mellon. Now, they're doing private repo, but does it look like the Fed's in the process of nationalizing the repo market now?
Yeah, I think a couple of things that I'd say is that the weeks leading up to the initial repos, there was a lot of chaos in the Chinese credit markets, and I would say that it's not a small coincidence that we have overnight lending and money market troubles within a reasonable proximity time-wise, with significant issues within the Chinese money markets and credit markets. I think as we've seen it progress from 35 to 75 to 120, as you noted, that we don't know who is suffering, but someone is suffering, and these are smoothing operations, accommodations within the market to benefit a particular player. And again, we don't have a post-mortem to work off of, but someone is suffering. And so that I think is what you generally see in terms of a cascade effect of concern within the financial markets is someone suffering. Nobody really knows about it. These actions would indicate that the Fed's going to go ahead and take care of it actively, aggressively, before it becomes a public issue. When it becomes a public issue, that's where the cascade effect really begins, because now you're talking about the potential for a loss of confidence in the marketplace and a questioning of counterparty exposures. Who are you working with? Who has your assets, or vice versa? So whose assets do you have? What claim do you have? When do you have to give them back? And again, this is where things get very dicey. And the structure of finance at present is not as healthy as your stock market indexes would indicate. So to me, the big issue here is, let's just keep everybody happy. Let's keep the markets operating as smoothly as possible. And the folks who are suffering, we're just going to make that go away, so that we never have to deal with, again, sort of a cascade effect.
So do you think it's possible that the banks that are tapping this overnight repo from the Fed the most, the facility that's growing, the term limits that are increasing, do you think it's possible it's a foreign bank with American subsidiaries? Are they even legally allowed to do that? So, I have no proof that it would be Deutsche Bank or HSBC Bank, but let's just talk hypothetically. Would these banks be legally allowed to have American subsidiaries, even though they're foreign banks, and then tap the repo market like crazy to help put out derivatives fires or bad loans at their other banking businesses outside the U.S.?
Well, what is regulated is the use of funds by those foreign subsidiaries, U.S. domestic subsidiaries of the foreign banks. And so they're not supposed to be able to take capital back. How that is monitored and audited, I couldn't tell you. But if push came to shove, is there creativity with off-balance sheet entities and special purpose vehicles where strange things can happen and it might go undetected during a short period of time? It's possible. And you bring up Deutsche Bank. There's at this point there's no. Here's what's fascinating. We have all this activity in the repo market, but you don't have a reflection of real stress or strain within your major banks. This week you had credit default swap spreads on Deutsche Bank move a couple points, but nothing that would suggest real stress or strain. JP Morgan continues to look like they maintain superhero status. They're bulletproof. At least their credit default swap spreads would suggest such. The prices on CDSs would suggest such. And Goldman, same scenario. There's really nothing showing up in those markets that would indicate real stress or strain. Roll the clock back, and of course, it was just a year ago that we did see indications of real stress and strain. Goldman Sachs, one of the worst. Deutsche Bank was under pressure too. And again, it's the CDS market that kind of tells all in terms of cost to insure. And the cost of insurance was skyrocketing fourth quarter 2018. We had the turnaround with Jerome Powell first quarter, actually within the first week of January 2019, and his complete U-turn in terms of policy. But all that to say, credit default swaps are not saying anything. And so there's a clear mixed message here. Huge interventionism from the Fed, but market participants to date are not worried.
I've heard rumors for years now that after credit default swaps in 2008-9 went crazy, that the large corporations and banks that thought that their credit defaults could spike higher, that the banks were manipulating and buying their own credit default swaps to try to fool people. So I've heard those rumors for years. Obviously, I don't have a lot of proof of that, but I've heard that CFOs of these highly leveraged large corporations and banks, they realized that the CDS was sending a big signal, and they've tried to mask that signal for years. So I'm not sure if that's happening. The big credit default swap spike is SoftBank out of Japan, but let's not cover that right now. So the banks have been fast and loose with the rules. They're always trying to bend the rules or break the rules or change the rules. The banks actually created the Eurodollar market. So the U.S. was on a international gold standard still before Richard Nixon suspended payment of gold. The European banks were creating excess dollars and credits offshore outside the United States. So that Eurodollar market back then, that was in the 50s and 60s, that was tens of billions of dollars of money and fiat currency and credit of dollars that were not supposed to be created because the U.S. was on the gold standard, and the European banks and then the American banks with European subsidiaries joined in. So the banks have a history of, going around the rules or changing the rules or cheating.
Yeah, I mean, that's and corporations in general have figured out what they've called regulatory arbitrage, where tax arbitrage is nothing new, where you've got corporations that may set up in the Caymans or set up in the Channel Islands or Bermuda. Tax arbitrage, regulatory arbitrage. It's not just the banks that get creative in terms of operating. Obviously, the impacts of the banks doing that are far more significant to the global economy because it's tied to money and credit and the flow of money and credit. So that I think is a big deal. That the issue I think is worth talking about certainly is the QE, which has been initiated already in the Treasury bill market, and that to me, again, speaking of muting signals, you mentioned CDS. I think the clear example of muting signals is you've got yield curve inversion. Up to 12 months ago, the San Francisco Fed was affirming the validity of the signals that come from yield curve inversion and what that implies for recession. And so we've got a signal of sort of pending. We're in a cycle where we could and should expect a recession. and lo and behold, we're buying, $50-60 billion a month in U.S. Treasury bills. Flattens out the yield curve, takes away the signaling, and to me, it's again, remove the pressure points and remove those things that suggest that there is concern in the marketplace or troubles ahead, and that is apparently what the $60 billion a month is, sort of putting lipstick on the pig.
Did you see the comments that came out in the last couple of weeks by the current president of the Dallas Fed? He is saying, I'm not sure how much information he has, but he said that the Repo Madness is starting because of how much money the U.S. Treasury has borrowed in just the last couple months, over $800 billion. So he is blaming that as the U.S. Treasury crowding out others who need dollars.
It's a good point. I mean, they're not the first. The Treasury is not the first to create a crowding out effect for investor dollars in the fixed income markets. That's been the case for the last couple of years in Europe, as the European Central Bank's been buying up prized, liquid, and good quality credit, and people are being forced, savers are being forced into lower quality credit, higher risk assets to get their income needs met. So, this is perhaps just a continuation of that same theme, Jason. You sign of the times. When central banks get active and start buying up stuff, the real market participants get squeezed and crowded out.
Yeah, it seems that a lot of the mistakes from the 1920s and 1930s are being repeated. The beggar thy neighbor policies with currency wars, trade wars, tariffs, tit for tat retaliation. I think the Trump administration, the Federal Reserve, the U.S. Treasury, they don't want a strong dollar. They're not going to go and admit this publicly. They want to weaken the dollar, but they want to control devaluation. So that's why you see all these central banks, whether it's the Bank of Japan, the European Central Bank, and the Federal Reserve, all desperate to try to weaken their currencies.
You're not talking about a massive devaluation. You're just talking about a gradual, slow process. And it's the same. If you look at the same commitment the Fed has made to their inflation target, they've told you that they want to devalue or create 2% inflation, which in practical terms for a U.S. person buying and selling goods in U.S. dollars, it has an impact over the long haul. And they're not talking about inflation of 10 or 20 or 50%. They're talking about inflation of 2, 3, 4%. So, what they consider to be benign levels. And what's the justification? Ironically, in the face of one of their stated mandates being price stability, currency price stability, the justification is it drives economic activity. So, yeah, I mean, I think they're well intended. They're working off of theories which justify devaluation, and when all your central bank players are doing the same thing at the same time, and everybody wants a little bit of devaluation to promote a little bit of healthy economic growth, what in their mind is healthy economic growth, then yeah, what is it other than low scale, not high scale, but it's the same version, as you say, of the 1920s and 30s competitive devaluation. It's not on a scale that anyone is afraid of because it all seems under control. To me, Jason, I think one of the key things that we lose sight of is, in behavioral economics certainly brings this into the picture, there's this presumption of control, and they're playing with small numbers, so there's nothing really at risk because they're pulling the levers like the Wizard of Oz behind the screen. But what they can't control is the man in the street and the mass mind as and when we, for whatever reason, decide to react to what they consider to be quite reasonable policies and reasonable implementation of those policies. And that's where you see really weird stuff happen in the financial markets. And it comes as a shock and a surprise to the PhDs who are implementing the policies. Because in theory, it should be fine. But ultimately, psychology is involved because you and me, and in aggregate, us, do impact market pricing far beyond anything that they can sort of maintain wraps and control on.
Yeah, I think a lot of people were betting that the dollar would be much weaker relative to other fiat currencies after 2008 and 2009. A lot of foreign governments, a lot of private banks, a lot of foreign corporations, they borrowed massively in dollar-denominated debt. The trade was to bet on a weaker, much weaker dollar relative to the other fiat currencies. And here we are, despite not QE program at $60 billion per month announced, despite the Repo Madness going enormously up to at least $120 billion offered overnight, and the dollar index is still above 97. And this is much more worrying, in my opinion. The trade-weighted dollar index, which measures the dollar against 26 other emerging market currencies, that's almost near an all-time high. That's above 129 the last time I checked at it. So there's a lot of dollar-denominated debt, David, that in the global economy, it's more than doubled since 2008. So do you think that's a major crisis point there, that could have a big problem in the near future?
Certainly dollar-denominated debt, and that pressure points on folks who've borrowed in dollar terms on a cross-border basis. That's been one of the recipes for major problems in the debt markets. And you can go back to Lex Riefel's restructuring sovereign debt, or some of the other, classic references for dealing with debt crises, and that's one of the things that they highlight. I don't know if you've ever played the game snooker, Jason. It's like pool. Are you familiar with it at all?
No. I used to have a pool table though.
Well, this is a bigger table, so up to 12 feet long. There's a lot of green there. The balls are smaller. The holes that you're aiming for are smaller, the multicolored balls. And this is kind of classic. If you think of British foreign policy, 100 years ago, maybe even today. And I think what we're doing with the U.S. dollar and weaker dollar, but, we can weaken, but at the same time, we're not weakening relative to others. We actually are still relatively strong. It reminds me of snooker, because you can win points either by making good shots when you're playing snooker. You can also win points by preventing the person you're playing against from making a good shot. So this is where if I hurt you, I help myself. And that's where I see dollar strength not on an absolute basis, but to the degree that we are maybe even at the periphery influencing destabilizing events, even the trade war. These are things that give us a benefit because we are still viewed as a liquid capital market, the deepest financial markets in terms of the depths of the capital markets. We're the deepest, we are the biggest, we are the best at this point in history. And so if anyone around the world, whether it's the emerging markets or the British or the Euro, the RMB, the Japanese markets, if we can create a bit of destabilization, it hurts them and helps us. And so we can kind of control the glide path of the dollar down gradually, but again, we're all going to benefit from panic money seeking U.S. dollar assets. In that, again, it is like snooker. If I hurt you, I help myself, and it's a weird game, and it's absolutely British when you think about sort of the gentlemanly approach of, that was a beautiful shot. Not only did I make a point but I hurt you by preventing you from making the next shot. You can't make the next shot, therefore I win points. That seems to be our dollar policy today.
And I know you've studied a lot of financial history, David. It seems that President Trump and the Trump administration seems more aggressive about using tariffs to get policy he wants, weaponizing the dollar, threatening to remove other countries, their banks, from the SWIFT system. I know Kyle Bass has talked about this in public interviews for the last 6 months, that if things continue to get worse and China continues to retaliate against the U.S. in the trade war, this tit for tat, that the 4 largest Chinese state-owned enterprise banks could be entirely removed from the SWIFT system. So I don't think I've seen this aggressive weaponization of the U.S. the global financial system the U.S. has control over in the dollar before.
Yeah, I think the stupidity of Trump's tariffs is that the framework that we have in international trade is a multilateral framework, and he's going about this as if it's a bilateral framework. And so what he's pressing for, even if it resolves something with the Chinese, it completely neglects the fact that this is a multilateral issue. So his focus from 2016 forward has been trade deficit, trade deficit, trade deficit, trade deficit, and we're going to solve this. All right, well, how do you solve it if it's not on a multilateral basis? Just inking a deal with the Chinese, it doesn't get it done. It doesn't get it done. So I'm not exactly sure whether it's Lighthizer or the rest. I'm not exactly sure what they're pressing for. If trade's the issue. My assumption has been that they're not stupid and that the tariffs really aren't the issue in the first place, and that they're not trying to solve the trade issue. These are all excuses, again, to sort of meddle in the Chinese business and to create something that is destabilizing to the Chinese. Worse off for them is better off for us. Because at the end of the day, we're not talking about a trade war. We're talking about a struggle between two superpowers. This is an economic death match. And, so again, you can't declare that without essentially declaring war on the Chinese. So you cloak it in the language of tariffs, and on the face of it, it does look stupid. But maybe he's not trying to resolve the deficit anyways. Maybe he is just acknowledging the fact that as they've moved from number 5 to number 4 to number 3 into the number 2 spot following the United States in terms of economic superpower status, that we don't want to lose the number 1 place. And that does mean that we go back to a kind of statecraft, which is very mendacious, very Machiavellian, and maybe the best way to address foreign policy is using economic and financial market levers. It's no longer the State Department who's fighting the battle; it's the Treasury Department, and it's no longer. Does that make sense? Because I think that's the only way I can really wrap my mind around the tariffs.
There's so much corruption and leaks and people fighting against Trump here in Washington, D.C. metro area. Many people in many of the government agencies are 100% never Trumpers, anti-Trump. So I think he thinks that the best way for him to get a lot of his policy goals, I mean, look, he threatened tariffs on Mexico with avocados and all that to get policy, to get their military to help out with the borders. He threatened more economic sanctions on Turkey. I think he put more on Iran. So he's using tariffs first rather than diplomacy.
Right. And I mean, by personality, that probably makes sense, because if you're not naturally diplomatic, it's not like you can sit down at a table and say, all right, what are the things that we agree to disagree on? What are the things that we agree to agree on? I mean, there is no, constructive dialogue that you might have in an ordinary bargaining table. So it is threats and things that don't normally happen in amongst diplomats. But it actually is one of the ways in which he's been effective. Is he's breaking the model. He's breaking the model. Politicians don't want to do with him because he's not behaving like a gentleman. Foreign diplomats don't want to do with him because he's not following the rules of engagement. And so bull in a china shop is actually getting a few things done. And in the meantime, he's just pissing everybody off. But, at the end of the day, you do ask the question, is it effective? On the one hand, yes. Now, if you subscribe to Joseph Nye's idea of soft power, maybe we're blowing up all the soft power influence we've developed or had over the last 30, 40, 50 years. But again, I think he's interested in just moving the needle in his term.
I also
maybe
think
with the idea of getting a second term.
Well, I also think that Trump, deep down, he believes that these tariffs and and all the things that he's doing on China with more Huawei charges, that it will bring more jobs back to the U.S. I'm not so sure if that'll happen, because if factories do come back to the U.S., yes, those factories will increase U.S. GDP and tax revenues for the government. But a lot of those factories are going to be automated. So I don't think there's not going to be the days of like 5,000 human beings at a factory are long gone. Most of these factories have, a couple hundred people, and they're very automated.
Well, and I mean, keep in mind, everything that a politician says is intended to be heard by a particular audience. So whether you're a Democrat or Republican, whatever you do, it's a crafted message for a particular set of ears. And in this case, he has very effectively ripped the grasp of the Democrats on the labor vote. And he's done it, and he continues to do it by hammering on this issue. Whether we get one job back in the United States or 1,000 jobs or 100,000 jobs, that's actually not the point. The point is he has an audience, the audience is listening, and the audience appreciates his sensitivity or apparent sensitivity to their issues and their plight in terms of job security. So, you know, again, very effectively, everybody wants to say, gosh, this guy's an idiot, and certainly in D.C. circles, I just came back from Manhattan a couple of days ago, and it's tough to find anybody who has an even mildly positive thing to say about Trump. But look at what he did. He has spoiled one of the go-to pools, voter pools, for the Democrats. That's you know, in terms of street smarts, maybe it's not like, you know, massive IQ smarts, but it's pretty damn smart.
Well, yeah, a Republican had not won Pennsylvania, Michigan, Ohio, and Wisconsin since Ronald Reagan. So Republicans have been talking about winning those states for a long time, and no one was effective at it. So he's got a good shot at re-election, because even if he doesn't bring back massive headline jobs numbers, I think I agree with what you're saying, that people in those states see that he's at least trying to fight for them, to bring back jobs.
Right, and if he doesn't move the needle on that at all, but what he does get to say is, I could have done more, but the Democrats obstructed.
So I want to ask you now about the Bank of New York Mellon. So I was on their website, and they were bragging about how big they've grown their repo market. So correct me if I'm wrong on this. The way I understand what they're doing in the private repo market, and they took over, about 3 years ago. They're custodians for the private repo market, and they act as a middleman. So they take people's savings in the money market accounts, and then they allow leverage, and they give that to hedge funds, and then the hedge funds lever that up and make bets in other markets on that. Is that how the private repo market works? Because Bank of New York Mellon took that market. There's a chart. They took the size of that market from zero, and in 3 years now, it's around $100 billion or more per month now. $100 billion. Yeah.
Yeah, I think one of the dangers of concentrating the flows for the tri-party repo market is that, you know, you're dealing with a bottleneck, essentially a bottleneck. And this is one of the things that I was pointing out in the commentary I recorded a few weeks ago is, yeah, it's okay to have competition in the marketplace and to not have sort of, you know, a singular toll road in or out of a particular market. And BNY Mellon, the fact that they've become the player, it's actually a little bit disturbing to me. It makes them a very significant, you know, to borrow the phrase, significant financial institution, or SIFI, from that vantage point. And, you know, is it possible? Is it possible that, again, the constraints within the repo market mandate or require more Fed involvement? Is that in fact what we are seeing? Again, there's 1,000 possible explanations for what we started the conversation around Repo Madness. We know that it started out as a low-level commitment with a relatively small dollar figure, relatively, because it's grown 2, 3, 4 times larger in the interim. And it was supposed to be for a week, and then for a month, and now for several quarters. So there's been something that's happened structurally, and again, we don't know who's the walking dead or the wounded here in the financial markets, but they have been required to increase, that is, the Federal Reserve has been required to increase their commitment, both in terms of the longevity to repo market smoothing, and in the total quantities. And nobody knows exactly what's happening. So I've got a theory, you've got a theory, there's 10 different theories, and some people would say this is just not a big deal. This is not a big deal. And as they claimed initially, not a big deal. Look, you had tax issues at the end of Q3, and so it's just been, you know, we're dealing with that disruption, and there's still some ripple effects. So you throw the rock in the water, and you've got the first ripple. That's what everyone sees and reacts to. But yeah, you're still going to have multiple ripples after the stone hits the glassy surface. So we're just still dealing with those, but nothing else beyond that third quarter tax issue. Again, it's one of the theories.
So aren't money markets supposed to be invested in very safe, very liquid, low interest investments, right? Short-term oriented, normally not long-term. And here we are, it looks like Bank of New York Mellon has taken those money market savings and they've allocated them to very highly leveraged hedge funds, and that they've allowed the hedge funds to invest that money market with those money market funds with leverage into God knows what.
So I think one of the important things that this brings to mind is that Bank of New York Mellon and all of your big banks and hedge funds make certain assumptions about their access to liquidity. And whether it's through the repo market or by putting up quality collateral so that you have money to go and sort of build up a P&L or leverage a balance sheet. What are we talking about here? We're talking about speculation based on the assumptions of that liquidity continuing to be available. And Jason, I think one of the things that we've already forgotten, I mean, this is 2008, 2009, a virtual replay where we weren't dealing with solvency issues. We were dealing with no issues at all, and then all of a sudden, overnight, we dealt with a liquidity issue, and then boom, once you dealt with a liquidity issue, solvency issues were, kind of the soup of the day. That's what we were dealing with right in front of us. So here we are again, playing with liquidity, making assumptions about liquidity, and the tap can be turned off. You've got structural constraints now with the tri-party repo market being managed almost exclusively by BNY Mellon. And $2.5 trillion market's kind of a big market. So, you make assumptions about liquidity, and then if you're ever wrong, even to a small degree, the ramifications, don't we know this from recent history? But somehow, we've forgotten liquidity issues become solvency issues pretty quick.
Yeah, and the Keynesians always see a liquidity trap, even if they're the ones who have created the bad market behavior with too much leverage and making the banks or corporations think that they have automatic bailouts.
Right.
So I want to ask you another question. This is like the 64,000-foot question. I see a lot of, I call them economic landmines. I see China as a big problem, the Chinese economy, banking system, their credit bubble, their real estate bubble. I see the corporate bond bubble with junk bonds, leveraged loans, collateralized loan obligations, which I think are the most toxic thing I've seen. I even got some internal documents from a whistleblower, one of the credit agencies recently, who listens to my podcast. And the stuff that's in these leveraged loans and CLOs is amazingly toxic. And then we also have emerging markets with dollar-denominated debt and problems with the U.S. government. Do you think it matters what collapses first, and that will determine who gets to either fix the next system or in charge of a global reset or have more say in the next global financial system? Do you think it's that important what collapses first and then what comes immediately after the aftershocks?
If you're looking for an asset to short, it matters, what the trigger is. But figuring that out ahead of time is not always that easy. If you look at some of the folks, including Paulson, part of the reason they won in the 2008 timeframe is they got to package. They basically got to poop in a bag and then bet against the poop in the bag. I mean, it was awful. But it wasn't like making a market call and saying, well, I'm going to bet against mortgages. They helped structure a piece of garbage and then bet against it, which is, I mean, I don't think that's cheating necessarily, but it's not making a market call per se. It's just picking on. Anyways, to me, you look at the system of weakness. You look at the financial markets that we have today, the inherent frailties within the financial markets, given the high degree of leverage that's in them, and no. It doesn't matter what the trigger is. I've said this many times before. I do a lot of backcountry skiing. I'm bringing my boys into that this next year, teaching them the first thing that they need to learn is avalanche mitigation, avalanche control. There's certain days you don't go out. Certain days you just stay in, don't go play. Because if you go out into the backcountry and there's already a lot of snow on a steep hillside, the conditions are set. And you might do everything right, but the snowmobile in the valley next to you could end up triggering the instability which is right above your head, and you're buried and you're dead. And so through no fault of your own, you pay the price for something that happened the next valley over or 5 miles away. And this is where you just, as an investor, you have to be aware of certain market environments that are highly unstable. And when that's the case, make sure that you de-risk your portfolio. We like cash. We like precious metals. We would suggest a well-managed market short. That's one of the things that Doug Nolan does for us on staff. And, so these are ways that you'd say, all right, number one, know how to go dig your pit and know what the levels of instability are in the snowpack. And number two, have the good sense to back down and go have a cup of hot chocolate instead of skiing if the conditions are really nasty. Don't be stupid. And I think a lot of investors assume a lot about their ability to get out of harm's way. And, this is where, again, I love the natural metaphor with avalanches, because you're talking about a snowpack that can move 300 miles per hour at max speeds, and you can't get out of the way. You can't. Once that is triggered, you just wish that you hadn't been there. And I think that's where, if investors are not proactive in de-risking their portfolios now, you already have all the evidence, ample evidence, that the structure of the financial markets, we're not talking about the economy, but the structure of the financial markets is unhealthy. You mentioned CLOs. You could talk about your investment grade bonds. That whole market was 1/3 of fixed income. The triple B rated very bottom of the rung bonds. Now it's half the market. There's more and more people squeezing into the bottom rung. You have any sort of a credit event, and now all of a sudden the triple Bs, which were investment grade, are now high yield or junk bonds, and there's so many mandates that require them to get kicked to the curb instantly. So again, we assume we have liquidity today with triple Bs, that's fine, but tomorrow they may not be, in which case, what do you have? You get just a ton of junk and no home for it. So we're at a very interesting place, Jason. Setting new highs in the stock market. It's fun on the upside if you're playing it, but the presumption that the central planners have this under control, and the presumption that you can continue to create garbage within the system. Covenant-like loans. We're back to levels in terms of the percentage of loans being put into the marketplace that are covenant-light. It's a repeat, 2005, 2006, 2007. We're doing the same exact things because boldness re-enters the mind. It's a brashness and a boldness which I just don't know how it ends well. Doesn't mean that we have to see things fall apart in 2020 or 2021. Rationality can reign for a long period of time. But I think the prudent see danger and take refuge, as an old book of wisdom said, but the simple and maybe the stupid keep on going, and they suffer for it.
Yeah, there's a lot of people out there, David, mostly in the mainstream media and mainstream financial media and on Wall Street, professional money managers, who think that the Federal Reserve won't allow the stock market to crash now. Like, I hear just permeable optimism. I just saw a new article today about how when the Fed cuts rates 3 times quickly, even if they take a break from rate cuts, that's good for the stock market. I mean, they're grasping at straws to find any positive or bullish past historical reference or any piece of data point that they can spin. I remember that they had on for an interview the guy who did the research, the Duke professor, finance or economics professor, about the inverted yield curve, and Bloomberg was tearing him apart, saying the inverted yield curve is not a good signal, or there could be 2 or 3 years of stocks going up a lot. So they were just, cross-examining him. It felt like he was, a hostile witness, and they were treating him that badly for 5 or 6 minutes on TV.
Yeah, and again, I mean, did they have the San Francisco Fed on, who, again, less than 12 months ago was doing their research papers and saying, no, that we've confirmed and reconfirmed that this is a very valid signal, and the inverted yield curve is something we should take seriously. We could have some issues here. This is, people see what they want to see, and I don't want to say this is all down to personality, but there's optimists and there's pessimists, and the pessimists usually pat themselves on the back as being realists. The reality is some people see the glass half empty and some see the glass half full, and you get the flavor for that. Maybe you're a half empty guy, I'm a half empty guy, and the mainstream media is a half full set of people. Investors have got to engage and objectively say, yeah, the world has a bunch of people out there that are wired differently. But let's look at the facts. What does the math say? Where are we at in the cycle? We're entering the 124th month of an economic expansion. Well, gee whiz, that's only the longest period of economic expansion in U.S. financial history. So what makes us so special that we get to go 130, 150, 170, or maybe we never see a downturn in a business cycle again? Because, yes, through our genius and acumen, we've broken the code and made it possible that there's no more business cycle cyclicality. That's the presumption that an investor has to have today. So how does it stack up, Jason? 124 months of economic expansion? Thank your lucky stars that it is where it is. It's great. But don't assume that the future is going to be reflected in the immediate past. You cannot project what you just experienced over the last 2, 3, 6, 12, 18, however many months, 124 months, into the immediate future.
Well, rather than the glass half full, glass half empty, I like to think of it as like the sports analogy that I think all the people on financial television and the Wall Street people and professional money managers are playing way too much offense. They're being way too aggressive. But then again, they have to, or it's career risk, because if they go to cash, they'll get fired. But the average retail person doesn't have career risk for playing defense. So I think it's smarter for people now to be more cautious and to be more defensive and play more defense rather than being very, very aggressive on a lot of investments or trades.
Yep, it's just, I know a guy locally just sat down the other day and he's like, yeah, I'm going to put zero down on this home purchase because I just want all my money in the market. It's working so well for me right now. And there's no argument that I could make that would dissuade him of potential downside in the stock market and moving into a real estate purchase with zero down. To me, it was a great sort of confirmational signal that this is back to psychology. The markets move, catering to greed or fear throughout the cycle. And I think I know where we're at in this cycle. If we're not at, we're awfully close to peak greed, where everybody believes that this is absolutely, never been better. The pessimist would say to the person who says it's never been better, you're probably right, and draw a conclusion from that, and draw a hard conclusion from that. So they can both agree it's never been better. But you have two different actions taken, and at a minimum, just reduce your risk a little bit. Raise 10% cash, 20% cash. Do something which is against the current grain of positivity and bullishness. And I can tell you, if anyone out there has studied market cycles, just moving a little bit in the opposite direction from the major trend ultimately has served you well. Jeremy Grantham did this turn of the century with tech stocks, blowing through the roof, and from a valuation perspective, things that we had never seen before, price earnings ratios sky high. In fact, the highest valuation metrics we'd seen in world history. And he starts trimming back risk in the portfolios. Half his clients fire him. GMO saw a 50% reduction in assets under management as prices are moving higher, not because he was losing money, but because investors demanded that he be fully invested and take full risk because they were trying to keep up with their golf buddies. And if they made 10% in a month, their desire and compulsion was to put up 12 or 14. It's just manic. It's manic. And GMO has just come out and said the same thing. We're taking career risk. We don't care. We're always going to do the right thing. This is how we roll. Like it or not, love us or leave us, we're going to see you again, because you fire us today, you'll hire us again tomorrow. In retrospect, you'll know we did the right thing.
And I think the Fed really started getting aggressive with rules changes under Greenspan in around 1987, the 1987 crash after that. The Fed became very stock market focused, very on interventionist policies, with less than 10 years later with the Mexican tequila crisis and Asian tiger crisis and long-term capital management. So basically since 1987, I think every 7 to 10 years, David, there's been either a global financial crisis that the Fed has had to increasingly put liquidity or change rules or do bailouts for an entity, or a stock market crash. So like clockwork, this is the first time I think in where we have not had another major global financial crisis or stock market crash in that 7 to 10 year period since 2008.
This time is different. This time is different. We now have negative rates, and we can, if you read the IMF paper from April, it argued that we could take rates deeply negative. You just have to shut down the financial system, not as in close it, but make sure that people can't get out of it. Once they're in, they're locked in, kind of like a financial or economic Berlin Wall. The guns are all pointed in, and the wire at the top, the razor wire at the top, is to keep you inside. The IMF paper in April was absolutely fascinating because it argued this time is different because we can do things that conceptually were unacceptable, theoretically impossible in every prior period in history. Let's take rates negative. Let's take rates deeply negative. And if you think you can hide with money in the mattress, no way, no how. We'll orchestrate the commercial banks and make sure you cannot get out. Extracting value from the saver, extracting value from the prudent who've been putting money aside for future events, absolutely is what they intend to do, at least if the IMF gets their wishes. A fascinating paper. I would not miss it.
Yeah, I didn't read the paper. I listened to the McAlvany weekly commentary about it. But this all goes back to Keynesian economics, right? He was talking about the paradox of thrift, and savers are bad, and central planning is the key to a successful economy, and fighting deflation and avoiding booms and busts, because Keynesian economics, if it was practiced correctly, at least in theory, it was supposed to be counter-cyclical, although that's never happened because governments have never built a surplus to spend in bad times.
Well, I think the other reason it can't be counter-cyclical is because after World War II, the budget became politicized. And so you can't make decisions that will like we heard from, I forget the gentleman's name. The Fed's supposed to take away the punch bowl. That's not feasible. It's not politically possible. Even though there's supposed to be this political disconnect between the Fed and government, you don't see the counter-cyclicality. You see pro-cyclicality, and you don't see the counter-cyclicality because it comes with a huge political cost. And it didn't matter prior to World War II. We didn't have universal suffrage prior to World War II. Now, but post-World War II, now all of a sudden the budget is politicized, and politicians insist on everything always being great. We got to have a bigly economy every year, and we don't want to see any downside. Now, I'm not saying that I want to see downside. This is not some sickness in my mind. It's just normal. It's normal that there is ebbs and flows. Tide comes in, tide goes out. You have seasons where there is death and rebirth. And a part of what we saw developed in the ideas of creative destruction is that capitalism is beautiful and elegant and cruel. and people don't like the cruel aspects, particularly if you're in the political seat, the political hot seat, because if people are experiencing pain at the point where you're being reelected, you're out, right? So monetary conservatism is gone, fiscal conservatism is gone, and nothing more galling to me than listening to a Republican talk about fiscal conservatism, because they're some of the worst. They know how to spend money like drunken sailors. And I'm just saying, there is only one class of politician, and they love to spend. So to your point, I think this is the challenging point in history. I think we're getting closer and closer to inflection. What we saw 2017 and 2018 in terms of a massive desire to own gold in the Asian and European markets, we began to see some of that breakout in 2018 and 2019, a little follow-through in the U.S. markets, a little follow-through, because I think there's enough common sense that says, no, it's not different this time. You can tell me that you've got latitude to take interest rates below zero. You can tell me that you're going to, quote unquote, redefine the natural rate of interest and define it on terms that are favorable to you and your theories. But it just doesn't, no. I think I'm going to go ahead and take some money off the table. So you have had a move in multiple jurisdictions where the negative interest rate game's already been played, where destruction within the banking system is happening. Bank profitability in Europe is awful, in part because of these negative rate policies. And what do you have? You have people like you and me saying, I think I want to preserve value in ounces. I want money in a financial asset outside the financial system. And so they're moving to do that. I think, I love this program, the Vaulted program. Vaulted.com is the program we launched to basically be a substitute for banking and savings. If you want to own $5 worth of gold or $50,000 worth of gold or any quantity of gold, you can do it and buy it and sell it on your smartphone or computer at Vaulted.com, and it allows you to be your own banker. And it was fascinating. I sat with an IMF official, a guy who actually was CEO of the largest Chinese investment bank, just recently retired, and he asked me the question: Do I think it's really feasible that gold be a part of our monetary system in the future? I'm not sure it is, but all of us individually can put ourselves on our own gold standard, and that's what I intended to do with Vaulted. I wanted my 5, 8, 10, 13-year-old kids to be able to save in the most reliable currency. It has been the most reliable currency through time, the only thing that has legitimized currencies through time. And certainly when we get into the period of crisis that I think is immediately ahead, there is going to be a demand for the metal. Again, I don't know that that's going to be the case for central banks, but I think individuals can certainly protect themselves that way.
Yeah, I don't think the central banks that are buying physical gold are planning on backing their currencies with gold. I think they're buying gold for other reasons, to diversify out of the dollar, protect the reserves, hedging. They don't know what the next financial system is going to be. I don't think they're buying all this physical gold to go to a gold-backed currency like the gold community is saying. But what I see a lot of very smart people in the financial industry that are not gold bugs, people like Sam Zell, people like Mark Mobius, people like Jim Bianco, not gold bugs, and yet they have disclosed publicly since January that they are buying physical gold on every dip. And many of them have said that they've never bought physical gold before and that they are worried about all the different signs, whether it's the real estate market, corporate bonds, China, emerging markets, other problems. So they are worried and they are buying physical gold. And again, they're not gold bugs, but they're looking at all the problems in the global economy and they're saying this is not sustainable. And then I see Mervyn King's comments recently, and Mervyn King is talking about how there needs to be more secret meetings with politicians and central bankers, and that just worries me because the average person on Main Street, David, if that happens, there's going to be rules changes. There's going to be normally policy decisions that people on Main Street are not going to be aware of, and the average person, Joe or Jane, is going to get screwed even more.
Which I think argues for why you would want to own gold in this period of time. It's stupidity insurance. We know that there's, of the crises you mentioned, from the tequila crisis forward, none of these things have been anticipated by the policymakers. They've always been caught on the wrong foot. And, I don't think they're going to see the next one coming either. So as they get more secretive, as Mervyn King suggests they should be, I think what we end up with is more stupidity. Where they're just, now they have to do what they have to do on an unannounced basis, but we still get to deal with the ramifications of their stupidity. You want to own some political stupidity insurance, and I think gold provides that. It's a very simple and elegant way to do it. Other people would say, well, you can get better bang for your buck in cryptocurrencies or whatnot. I'm going to go with what has worked for 5,000 years and just call that good.
Well, David, you are a wealth of information. I highly recommend my listeners take a peek at the McAlvany Weekly Commentary. It is one of the best sources of free information and education out there available. You have great guests. You have great show topics. It's really good, and again, it's free. I listen to it basically religiously every single week for years now. I think over about at least a decade, I would say.
Can you believe that? We've done it for over 11 years now. It's 617 or 620, something like that, episodes every week. And it's been a privilege to carry on the conversation and engage with listeners and have different folks on the commentary. So yeah, appreciate your kind words.
And if my listeners want to take a look at McAlvany Wealth Management or the Vaulted app, how do they do so?
Yeah, vaulted.com is we launched the app in the first quarter. And between now and then, you can find it online at vaulted.com. Kick the tires on it. Takes you less than 60 seconds to open an account. It's a pretty fantastic way to approach the gold market. Very low cost, and again, it provides. We're just launching the ACH feature where you can save $10 a month, or $100 a month, or $1,000 a month straight out of a paycheck, and great way to save in a reliable form of savings through time. The Wealth Management Group, great team, and would encourage you, if you're interested in real assets with strong cash flow, that's kind of been our focus, in addition to what Doug does for us on the tactical short, at M as in McAlvany, Wealth, M as in management, so mwealthm.com. And, the commentary you mentioned, McAlvany commentary, you can find that at iTunes or just about anywhere podcasts are available.
And lastly, your bullion dealer is one of the few that offers trading the gold and silver ratio, right? There's limited commissions and fees, right? Because almost all the other bullion dealers, you can't trade the ratio. There's enormous, you have to take capital gains and fees. Your bullion dealer has that solved, right? Do you allow that?
Well, I think a couple of the things that we do is, we take a very consultative approach. We act as advisors where people want that, and we're able to construct portfolios that allow for a gain in ounces over time, not just waiting for a price in the metals, but different things that allow for you to grow your financial footprint while you're waiting for the price of gold and silver to move higher. So we've been doing this since 1972. As you mentioned, my dad was one of the few people involved in getting gold legalized here in the United States. We've been at it a long time, and we've seen the cycles and played the cycles very effectively. So working with one of our advisors, you're getting decades of experience. And I'm not saying decades of corporate experience and a new guy who was selling Hoover vacuum cleaners last week. No. I'm talking about Larry's been with us 38 years. Rob's been with us 36 years. I can go down the list, and we've got this huge crew of people who have decades of experience. If that's of interest to you, you want to understand how to benefit from, as you say, the ratios and whatnot, you won't find a better crew. You won't find a better crew. We love what we do. We make a decent living. We do not make a killing. Our pricing is middle of the road. We're not the cheapest in the industry, but I do think we deliver the very best value.
Yeah, I was surprised and impressed to hear that despite gold and silver prices not rising, some of your ratio trades. I mean, that's really outside the box contrarian thinking, how well some of those ratio trades have done.
Oh, the last trade we did between platinum and palladium netted us 350% ounce gain. And this is, again, you think, well, which metal helped you? Which metal hurt you? We just care about the ratios. The price is less relevant because over time what we're doing is expanding that financial footprint. It'd be like saying you started with 10 acres and over a lifetime expanded a 10-acre plot to 100 acres. Would you be interested in that proposition if we were talking about land or property or shares in a company? We're doing the same thing with ounces. Compounding ounces is what we call it, and we do a good job of it.
Yeah, I haven't heard any other bullion dealer talk about this before, so I think you guys have a competitive advantage there.
Well, thanks for having me back on the program. It's been great to be with you.
And keep up the great work at the McAlvany Weekly Commentary. It's absolutely fantastic. I love it.
I appreciate it.